Okay, so if you opened your portfolio today and just kind of stared at it like, ah, what happened here? Yeah, same. Because right now, the Dow, the S&P 500, and the Nasdaq are all pulling back, and not in a cute, harmless way. But don't worry, I've got you. Let's break this down together. Nice, simple, no panic, just clarity. So here's what actually happened today. The Nasdaq dropped about 1%, the S&P 500 fell roughly 0.8%, and the Dow slipped around 0.4%. Now, on the surface, that might not seem that dramatic, but the context, that's where things get interesting. Because this drop isn't random. It's being driven by a mix of geopolitics, inflation fears, and technical signals all hitting the market at the same time. And yeah, that combination, it tends to make investors a little nervous. 1. Geopolitical tension is back in the spotlight. So, let's start with the obvious one. Tensions between the U.S. and Iran are rising again, and markets absolutely hate uncertainty like this. Because the moment conflict becomes even a possibility, investors start asking questions like, are oil prices about to spike? Is inflation about to get worse? Are central banks going to stay aggressive longer? And when those questions don't have clear answers, money starts moving out of stocks. Not because everything is collapsing, but because uncertainty makes people cautious. End of point. Oil prices just jumped fast. Now, this one is a big deal. Oil prices surged about 4% to 5% in a very short time. And I know oil doesn't sound that exciting, but financially, it's everything. Because higher oil prices ripple through the entire economy. Transport gets more expensive, production costs go up, companies pass those costs on to consumers. And suddenly, inflation pressure creeps back in. And here's where the market starts to react. If inflation stays high, interest rates stay high. If interest rates stay high, borrowing gets expensive. And when borrowing gets expensive, companies grow slower, which means stock valuations start coming down. So yeah, one spike in oil can trigger this whole chain reaction. Kinda dramatic, right? 3. The Nasdaq is officially in correction territory. Okay, now this part? This is where people start getting a little uncomfortable. The Nasdaq has now fallen more than 10% from its recent highs, and that officially puts it into what we call a correction. Now, before you freak out, a correction doesn't mean a crash. It just means the market is pulling back after getting a little ahead of itself. Think of it like this. The market had a strong run, especially in tech, and now it's basically saying, okay, let's slow down for a second. And here's something most people don't realize. Corrections like this, they're actually normal, like historically normal. A 10, 20% pullback after a strong rally happens all the time. It's not a sign that everything is broken. It's more like a reset. 4. Tech stocks are taking the biggest hit, and, of course, the Nasdaq dropping this much means tech is feeling it the most. The same companies that were leading the market up are now pulling it down. And honestly, this was kind of expected, because valuations in tech, especially around AI, got very optimistic, like future potential level optimistic. And now investors are starting to ask, okay, but where are the actual earnings? How long until this turns into real profit? So what we're seeing is a shift. Money is rotating out of high-growth tech and into more defensive areas like energy, utilities, and safer plays. Basically, less hype, more stability. Yield 5. A key technical signal just flipped. All right, this part is a little more technical, but stay with me. All 3 major indexes have now dropped below their 200-day moving average. And in market language, that's kind of a big deal. Because the 200-day moving average is like a long-term trend line. When prices are above it, markets feel strong. When prices drop below it, confidence starts fading. Now, it doesn't guarantee more downside, but it does change how investors behave. It makes people more cautious, more selective, a little quicker to sell rallies instead of chasing them. And that shift in behavior, that's what can keep markets under pressure for a while. So, what does all of this actually mean for you? Okay, let's zoom out for a second. Because this is the part that actually matters. Right now, the market is dealing with geopolitical uncertainty, rising oil prices, inflation concerns creeping back, a reset in tech valuations, and weaker technical signals. That sounds like a lot, I know. But here's the thing. This doesn't mean the market is broken. It means the market is adjusting. And honestly, this is where a lot of people make the wrong move. They see red, they feel nervous, and they start pulling money out right when things get uncertain. But historically, this kind of environment is where long-term investors start paying attention. Not because it feels good, but because volatility creates opportunity. Like, prices come down, valuations become more reasonable, and suddenly you're not buying at peak hype anymore. So instead of asking, should I run away from the market? A better question might be, where are the opportunities starting to form? Because yeah, right now the market feels a little shaky, a little dramatic, a little unpredictable. But that doesn't mean it's dangerous. It just means we're in a different phase. Outro. So if you want, I can break down exactly what sectors I'm watching right now, what I'd personally avoid, and where things are starting to look interesting again. Because, trust me, this part of the market cycle, this is where things quietly get very, very good.